From New York City this morning, good morning, good morning. What a week in this market. Equity futures up by 1.4%. Will it stick? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
From New York City, we begin with the big issue, skirting a bear market.
This week has been pretty brutal.
We didn't think it would be this ugly.
The respite is one requirement for stocks to stabilize.
We've seen this week, finally, bonds behaving as a safe haven.
The stock-bond correlation is starting to fall apart.
Hopefully that's what we're watching now.
It may not be a screaming buy, but I certainly think there's lots of opportunity.
Certainly some version of a tradable rally.
Right now, you have to be very selective.
The mantra right now is quality and cash flow, dividends, balance sheet, and boring.
I don't think we have seen capitulation just yet.
There's just generally so many headwinds.
Approaching bear market territory now in the US.
If you're looking at the Fed to save us, I don't think they're coming to save us. They've got to hike.
We're going to have a tricky few weeks and months ahead of us.
Right now, we're just all trying to kind of survive.
That sounds dramatic. Joining us now to discuss, Mohamed AlArian of Bloomberg Opinion and Queen's College, Cambridge. Mohamed, is this the first time in 2.5 years? Back in a building together?
It is. It feels really strange, but thanks for having me.
Any coincidence that you're looking at buying stocks right here, that you're back in a building 2.5 years later? This quote from you yesterday, can we start here? Can we get that up? The tweet from Mohamed after yesterday. You said, Mohamed, given how massively underexposed stocks I was going into this sell-off, I dipped a toe in this afternoon via a small handful of high beta names. Can you talk to me about what you said yesterday? What do you mean by this?
So I looked at where we stood technically, and I thought that there was an attractive short-term opportunity. I want to stress short-term. I don't think this sell-off is over. In the risk framework that I've been talking with you, there's still one more step to go. But for the short term, it looked rather overdone yesterday, early afternoon.
Single names, high beta. Any more information than that?
No, we all know what the high beta is. And the reason why it was high beta is because liquidity became a concern, adding to inflation and growth. And high beta behaves like high beta when liquidity becomes a concern. So there's a sense that certain names have overshot on the downside. And for a trade, I want to stress, for a trade, they look pretty attractive.
So you don't think this is over by any stretch?
I don't know, but you know my thinking. It started out as an inflation scare or the interest rate risk. Then it became an inflation and financial condition scare. Then it became a growth scare as well. And there's one thing that you and I are keeping an eye on, market functioning.
And liquidity. Do you think we started to see some of that in the credit market yesterday? Just people going towards the exit and finding that that door was really small?
We did, and I'm surprised that they were surprised by the door being closed, being small, because the door has been small for U.S. Treasuries. We have seen price gapping. We have seen volatility in the most liquid of all securities. So, of course, on the credit side, you also get some liquidity concerns.
The Federal Reserve's not backing away. Have you noticed that? Every single Fed speaker, it's what they're not saying that interests me at the moment. You listen to Fed President Mary Daly, what she had to say just yesterday. I expect financial conditions to tighten even more. I would like to see continued tightening of financial conditions. Does that surprise you? Or is that a feature of what they're trying to do, not a bug?
Doesn't surprise me at all. They have a massive credibility issue. We have headline inflation at 8.3. The last report showed you that inflation drivers are broadening, not narrowing. They've got to get control of this situation. So it doesn't surprise me at all. I think the Fed will continue to talk hawkish. Now, whether they continue to act hawkish or start acting hawkish remains to be seen, but they will certainly talk hawkish for quite a while.
Chairman Powell spoke as well. This is what he had to say to Marketplace Radio. He said the following: the process of getting inflation down to 2% will also include some pain. But ultimately, the most painful thing would be if we were to fail to deal with it and inflation were to get entrenched. On top of this is Mike McKee. Morning, Mike.
Let's start out by congratulating Jay Powell on his encore performance as chairman, overwhelmingly approved last night, confirmed to a second term as chairman. And why not? Members of Congress probably feeling if someone wants to walk the point in the combat against inflation, they're willing to let him. Here's the reason that there is concern and what Jay Powell was talking about in terms of pain. pretty much every time the Fed has to raise interest rates, we see unemployment rise. That's part of the deal. This is the SOM rule. Well, that is not, but we have the SOM rule up. It suggests that the Fed is going to be sending us most probably into recession. What we know now is from Jay Powell, 50 basis points hike at the next 2 meetings, and then we get maybe 75 if they need it. The market sees an effective 2.7% rate by the end of 2022, but what we don't know there is where the Fed funds rate will end up and when inflation will return to 2%. Powell says it's going to take a while. And you mentioned what Mary Daly said. Here's what she's talking about. Since the Fed started talking about getting back to the tightening business, we have seen a significant tightening in various measures of financial stress. And we're seeing at this point the high yield bonds, we're seeing commercial paper, then we're seeing LIBOR, all rising significantly and starting to tighten financial conditions, which is a little bit of front running the Fed and exactly kind of what they want to see from all this. Next week, a lot more Fed speak coming up. John Williams, the vice chair of the FOMC, kicks things off on Monday. On Tuesday, Jay Powell again, this time speaking at a Wall Street Journal conference. A lot of people will be tuning in to see what he has to say there. Harker and Bullard also speaking. Retail sales, are Americans still spending? Housing starts in Harker on Wednesday, and then jobless claims and existing home sales on Thursday. And existing home sales will be interesting because we have seen mortgage rates go up. Are we starting to see sales really start to tail off?
Mohamed?
So I think it was interesting that Chair Powell said 3 things yesterday, taking a page from Andrew Bailey's book. First, as Mike said, he said, expect some pain. Second, he said, we wish we had started earlier on rate hikes. And then third, he left the door a little bit more open for 75 basis points, as opposed to what he said earlier on that. So it's good that we're getting Chair Powell speaking more honestly to the marketplace about how he sees the outlook. And I think the brutal honesty is really important at this stage.
Mike, we're getting brutal honesty and financial conditions are tightening even more. It was interesting that Mary Daly yesterday, Mike, basically said that was the intended consequence and she'd like to see more of it. Mike, I know this frustrates you as an economist, but there's a lot of market participants that want to know when the Fed put will come out of retirement. Have you got an answer for that?
At this point, I think it's not coming out of retirement unless we see some sort of disorderly market conditions. Markets go up, markets go down. The Fed knows that. And at this point, they don't have to move if markets are down like they are now, because that's kind of what they're trying to accomplish. Bring down some of the froth and also take some of the wealth effect out of the markets. And they also think we're not going to see the kind of 2018 ructions that we saw, because now they have the reverse repo facility in place that can handle that. So they think they can get by unless something really goes wrong with market functions.
Mike McKee, thank you. Mohamed, your thoughts on this? Just what's happening with financial conditions and how responsive you think this Fed should be or shouldn't be?
So I don't think the Fed should worry about price adjustments. The cost of credit is going up and should be going up. What it has to keep an eye on is access to credit. If access to credit becomes disrupted, not in high yield, but further higher up in the capital structure, then they're going to have a very difficult decision to make. And I'm not sure they can go back to the old tools at a time when inflation is at 8.3%.
We're reflecting on what happened in 2011, 2015, 2018, a variety of growth scares, all with their own unique nuances and traits. What we're trying to work out, is whether this correction leads to something more deeply entrenched, a bear market, that ultimately leads to the end of the cycle. Can you think of an analog here, some kind of historical parallel to the moment we're in, and where ultimately you think this heads? End of cycle dynamic, entrenched bear market. What do you think this is going to?
So this growth cycle is different because you look at the 3 major areas in the world, they're all slowing, and it's hard to argue that they're going to pick up anytime soon. China has a serious issue with COVID, and lockdowns will continue. Europe is looking at a recession this year, and the US is slowing. So take the growth scare seriously. It is yet to be fully priced into markets. And the worst thing to have is a growth scare at the same time as an inflation scare. But that's what happens when central banks fall behind the curve.
Where's the leverage right now? Where's the leverage that you'd be concerned about at the moment?
Well, the good news is it's not in the banks. It's in the non-banking sector, and we're seeing it coming out. We're seeing it coming out from areas where people ventured when they really shouldn't have ventured. So it doesn't surprise me what we saw in crypto. It doesn't surprise me what we're seeing in high yield. Keep an eye on investment grade. That's the key issue. Because if there's been excessive leverage taken there, then it's a completely different outlook. That's when finance contaminates the economy, as opposed to the economy contaminating finance.
The reason I ask this, of course, is because it gives you some indication as to what kind of downturn we could get in this economy if things go wrong. Have you given thought to that? I believe you have. If you have, can you share that with us?
So, unlike others, I do believe stagflation, unfortunately, is the baseline. We're going to see notably lower growth, and we're going to see frustratingly high inflation for this year and into next year. Whether we get something worse depends on the soft landing debate for the Fed. I do think that the left tail of recession is something that we must keep an eye on.
When you say stagflation, just on the growth side of it, what does that mean? Is that basically an economy that's not growing? Is it about the level, or is it about the rate of change? What's important there?
It's two things, about the rate of change and stabilizing at a growth rate in the 1% to 2% range. And that's too low for this stage of where we are in the economy.
So your baseline, 1 to 2 GDP, where's inflation at?
So I think we get stuck, unfortunately, in the 5 to 6 handle. And what we're going to see is we're going to see the third round of inflationary pressure. Very few people paid attention to the PPI yesterday. That's an 11% print on the PPI, 11%.
Do you think we've become desensitized to some of these numbers? What does that tell you that we did shrug that off? Is that good news? Has the market started to become more resilient, or is that just complacency?
I think it's complacency. I think we used to shrug off the CPI numbers. Now we focus in a big way on the CPI numbers. We haven't quite realized that the PPI numbers are a leading indicator of the CPI numbers. So we have got to focus on that as well.
Mohamed, we're lucky to have you with us. Going to be sticking with us. Counting you down to the opening bell about 20 minutes away with some movers. Here's Abby.
John, well, we have big gains for the U.S. futures, up more than 1%. Yesterday's late day, somewhat of a turnaround coming into today. However, the top stock not participating. Of course, I'm talking about Twitter. Twitter is down sharply, down more than 10% at this point. Of course, earlier, Elon Musk saying he is suspending his bid on the wanting to look more at fake accounts. Then more recently coming out, tweeting, saying he's still committed to the acquisition. So the stock off of its down 20% lows, down 10%. However, Tesla getting a bid off of this, outperforming, up 6.7%. Perhaps some investors, traders thinking more attention will go to his original baby. And then speaking of high beta names, I'm not sure if these are the ones that Mohamed is talking about, but Apple and Nvidia up nicely in the pre-market. Let's see, though, whether or not this bid can last for the day. Right now, it feels pretty solid.
Abby, thank you. Mohamed's not playing ball. He's not going to tell us. You going to tell us?
No, I think
He's
Abby
not
knows.
going to tell us. There we go. Coming up, what a week in the bond market.
We're assessing the damage that has been done and the value that has been created. Perhaps you can make the case we're finally starting to trade around some sort of fair value justified for these market conditions.
That conversation up next with Aberdeen's James Athey and Morgan Stanley's Brian Weinstein from New York. This is Bloomberg.
We're assessing the damage that has been done.
The market is simply on edge.
There's just generally so many headwinds.
Is it a soft landing? Is it a recession? Is it stagflation?
There is light at the end of the tunnel. Unfortunately, I think we're in the final stage of what is going to be a significant bear market.
We've seen this week, finally, bonds behaving as a safe haven.
They are clearly running to safety.
Your 10-year Treasury yield back below 3%. This week was interesting. Yes, another weekly loss in the equity market, but this time people bought Treasuries. For 4 straight sessions, yields lower, not higher, just a little bit higher in today's session. Let's get you up to speed. Let's get to Kelly Nice for more. Hey, Kelly.
Hey, John. Yeah, clearly things are reversing this morning from what we've seen over the past 4 days in that yields are actually higher to the tune of about 6 basis points on the 10-year, though, as you say, we do remain below 3%, and risk assets are catching a bid once again, not just when it comes to equities, but the likes of Bitcoin as well. Some stabilization in cryptocurrency markets. But essentially what you've seen today and over the last 4 days is this typical kind of 60-40 portfolio working the way you would think it would. On days that equities are down, bonds provide your haven. On on the days that equities are higher, you don't really need that safe haven assets. But clearly what we have seen over the last week or so really is emphasizing the fact that most of this has been risk off and that you've seen money flooding out of equities to the tune of about $6.2 billion in outflows, money coming out of credit as well, while yields and treasuries in particular have seen the inflows to the tune of about $7.3 billion. So again, the good news is the 60-40 portfolio actually worked as designed this week. But of course, it is equities that really have borne the brunt of this pain up until today, at least so far. We have to keep in mind how far they have fallen. Even with today's rebound, we are heading for a 6th straight week of declines across the major averages. For the S&P 500, that matches the longest losing streak since June of 2011. Of course, teetering yesterday very dangerously close to the edge of a bear market, John.
Kelly Light, thank you. We get lucky this morning. Mohamed, my co-anchor into the Open Inbound. Joining us now is Aberdeen's James Athey and Morgan Stanley's Brian Weinstein. James, first to you. A bond's back. Is 4 days enough for you to draw a big conclusion?
I'm not going to get too excited with a 4-day trend, John, to be honest. But I mean, it was inevitable, right? I mean, there was a valuation argument for why, many investors didn't want to own bonds when the 10-year yield's 50 basis points there or thereabouts. There's really not a lot to play for. And so obviously the combination of economic events that we've seen, high inflation, tighter monetary policy, all of these really huge headwinds for bonds. But there comes a point where, they're increasingly attractive in an outright sense. They're increasingly attractive relative to other asset classes. And of course, ultimately, if you are in the camp that suggests we're headed for slower growth or even a recession, eventually you would expect that central banks will be back to easing and you'll see yields fall again. So for all those reasons, and investors being hugely short bonds, I think, in recent months, it's not too surprising to me that at similar levels to 2018, we've started to see a bit emerging.
Brian, last time we caught up, you said 325, 350, you start to break the economy. 320 on Monday, we backed away straight away. What do you make of that?
Yeah, we got real close to my range, and I think that's right. I think inside of there, you're going to have pain, and the markets reacted accordingly. And I think what Mohamed's been saying about Fed acting credibly, central banks across the world, if they can act credibly, inflation won't come down right away, but bonds at these yield levels deserve a piece of the conversation again. You can get 7-8% yields in high yield. You can get 3 in treasuries. You can get in between other places. So at least they deserve to be discussed again. We're back at 1%, not so much.
James, we've seen quite a difference between inflows into treasuries and outflows from investment grade, which suggests that the market is comfortable with interest rate risk, but getting nervous about credit risk. Do you think this is a one-off thing, or do you think we should expect that divergence between investment grade and treasuries to continue?
I think it would probably continue, to be honest, Mohamed. I think it's been actually surprising maybe until recent weeks how much of the total return in the credit market had come just from the duration move. I think one of the sort of secular trends that we've observed over the last 15 or 20 years in particular is, as we've been in this kind of falling rate environment, this low yield, low return environment in the bond market, some of those longer term, longer liability types of investor, the insurance companies, the pension funds, have increasingly substituted their sort of core treasury or core government bond holdings for high grade credit just in order to try and, juice that return a little bit. If we are indeed in an environment where we've really seen the interest rate lows, where central bank policy is not going to be the, ultra easy, ultra loose, phenomenon that we've become accustomed to, then maybe we see a secular trend in the other direction. And given some of the sort of peak globalization and supply chain dismantling that we're seeing, I think it's reasonable to believe that we may be in a higher interest rate environment for the foreseeable future. So I do think some of these stronger hands in terms of core fixed income demand are likely to come back to core government bond markets relative to essentially what is still a highly levered sector of the economy in the credit markets.
So, Brian, given what James just said, should you be looking not only at your 325 on treasuries, but also looking at investment grade spreads when trying to assess the implications for the economy?
100%, Mohamed. I think if you look at investment grade spreads back where they were a couple months ago in that kind of 80 basis point range, historically been a great place not to own them. Now, we've spent years hanging out at that level, so people think it's okay. But I think what we're going to find is a new equilibrium where if there's more uncertainty on growth, more uncertainty on inflation, more uncertainty on rates, you'll find a higher spread. So if the average of the last 10 years on investment grades is 120 basis points over treasuries, maybe it's 145 or 150 as a baseline, which is not far from where we are today, which means we can trade cheaper. So absolutely, credit spreads, I think, are very important. And in the last few days, you look at high yield in particular, you can see just a little bit of that panic sneaking in. So I'm not sure investment grades where I look for the canary in the coal mine, but I also wouldn't expect spreads to go back to the tights there.
Brian, awesome to catch up. James as well. Mohamed, things are happening, aren't they? Just slowly in a way that they haven't been over the last few months. Credit was pretty resilient. We saw credit repriced, but largely because of rates. Spreads were pretty contained. What do you make of the recent move we have seen in spreads?
No, I think it's an evolution from an inflation interest rate concern to a growth and credit concern. And that just tells you that the market is going sequentially through the risk factors. Keep an eye on it. Those of us who grew up in emerging economies have seen this movie before. It doesn't all happen simultaneously.
You think this feels a little bit EM at the moment?
Oh, totally. It feels totally EM. Policymakers falling behind the curve, the marketplace taking on policymakers saying, you've got to do something, you've got to do something, policymakers starting to move, but the market's moving further away from them. And then at some point, it's no longer about finance, it's also about the economy.
How do you feel about reading the teas? Just going to break. Do you want to take care of that too?
Coming up, the morning calls.
And later?
Elon Musk taking to Twitter and stirring confusion about his takeover bid.
That conversation's still ahead. Michael Nathanson of Moffett-Nathanson. Could we make a career out of this?
No, I think...
Do a show together. Do you want to make this work?
Only if you want to look good in relative terms every time.
I don't know about that. I think you make me look bad whenever we interview the guests. From New York City this morning. Good morning. This is Bloomberg. Five minutes away from the opening bow this morning. Good morning to you. Gains on the session, but on the week, we're still heading for a sixth straight week of losses. I think Kaylee said it repeatedly now on a weekly basis, equaling the longest weekly losing streak going all the way back to 2011. Futures this morning up 1% on the S&P, on the Nasdaq by 1.5. In the bond market, we talked about this briefly moments ago. Monday, Tuesday, Wednesday, Thursday yields lower. Just a little bit of a lift this morning through the curve, up 4 basis points on a 2-year, on a 10-year up 6 basis points to about 290.76, but way off the highs of the week at 320 on 10s. That's the price action. Here are your morning calls. First up, JP Morgan downgrading UPS to neutral, seeing little upside due to a lack of near-term catalysts. Next up, Wolfe Research downgrading KB Home to underperform, pointing to numerous headwinds, including a hawkish Federal Reserve. And finally, Morgan Stanley upgrading Ford to equal weight, highlighting the stock's favourable valuation and his growing confidence in the C-suite. Coming up, Twitter under pressure as Elon Musk goes from temporarily on hold to still committed. That conversation with Moffett-Nathanson's Michael Nathanson next. Well, this was exhausting for many of you, I know. This is it. One more day than the weekend. Futures positive by more than 1% on the S&P 500. On the Nasdaq, up by 1.56 on the week. Deep into negative territory, heading for a weekly loss and looking to take a bite out of it at the opening bow. There's your opening bow. Switch at the board and get to the bond market. 10-year Treasury shaping up as follows. Yields higher by 5 basis points on a 10-year, 290, after having a little look at 320 earlier in the week on Monday. Euro dollar 103.60. What a move we've seen on euro dollar over the last few months. Bear in mind that going all the way back to 2003, this is it. We haven't been lower. In late 2016, it was 103.88, and here we are again. Looking almost to think about breaking 103, and maybe that call that never happened year after year after year after year. Parity. We're down 0.2% on that currency pair. Crude 109. Let's call it 20, up by 2.9%. That's the cross-asset price action about 30 seconds into the open. Call it 37. Let's get you some movers. Here's Abby.
John, well, we are certainly looking at a very solid start to the day, as you were just outlining. And shall I say it, high beta mega cap tech names seem to be really leading the way. Let's take a look at Apple, popping sharply higher, up 1.3%, holding very important support. Mohamed was talking about technicals at the 100-week moving average, attracting solid dip buyers. Tesla up 5.1%, perhaps in reflection of the same theme, high beta tech rallying. But plus, Elon Musk putting that Twitter bid on suspension. Maybe some investors thinking more attention goes to Tesla. GameStop, the truly high beta risk on Momo stock, up more than 10% after yesterday's 10% pop. And then rounding it out, Robinhood Markets up nearly 20%. This as FTX founders' 7.6% stake has been revealed. Given the 90% drop over the last year, though, John, I'd say there's some serious dip buying going on there, too. Overall, risk on this morning.
Abby, thank you. About a minute and 30 into this, there's only one stock to look at. It's Twitter. We're down by more than 10%, and we've been whipsawed from one tweet to the next from Elon Musk. Here's the first tweet. Quote, Twitter deal temporarily on hold pending details supporting calculation that spam, fake accounts do indeed represent a less than 5% of users. Then 90 minutes later, tweeting the following. Still committed to the acquisition. We're down by 10.6. On the West Coast, I'm sure he got woke up pretty early this morning. Ed Ludlow. Morning, Ed.
Good morning, John. Look, we're
Didn't
down
sleep,
more than
did you, buddy?
10%.
You're not feeling good.
I know. We're down more than 10% of the stock. The reality is that Wall Street continues to doubt the probability of this deal happening. Elon Musk was responding to a regulatory filing made by Twitter, which basically went through some of the math they'd done around the percentage of bots or percentage of users that are bots on the platform. They said it's less than 5%, although there is some margin for error there based on their calculations, partly because they take bots down and then as soon as they do, some are added back in. You have to remember, of course, that there have been doubts about the broader climate that we're in. We've seen a massive sell-off in technology shares. Hindenburg Research, a short seller, basically said that if you took into account that sell-off, there is a good chance that Musk could come back in with a lower offer or indeed walk away from the deal altogether. Now, as you said, John, Musk tweeted, this is temporarily on hold, quote, but later clarified that he's committed to the deal. It's not entirely clear what data or what more he's asking from Twitter management. Remember, we heard overnight, late on Thursday evening, that Twitter is frozen hiring, that some very senior managers have departed the company as they kind of wait to see how this plays out before making any sort of major structural changes to the company.
Ed, it's the story that people are talking about. The stock of Tesla is up by 4.7%. Your thoughts on that? It's difficult to try and get into the mind of someone. I think it's dangerous to try and work out what someone is thinking. But can you walk us through the connection that people are making between Twitter, Tesla, and what's happening this morning?
Well, you said it yourself last hour, John. We don't know what's in the mind of Elon Musk. There's two key points here, right? The first one is key man risk, that if the deal doesn't go through and he doesn't become involved with Twitter, he'd be more focused on Tesla. The other is the mechanics of the deal. Bloomberg News reporting on Thursday that Musk wants to increase the equity portion of the finance even further. You remember that he raised $7.1 billion of equity financing about a week ago. He used that to reduce the margin loan component of the financing from $12.5 billion to $6.25 billion, which basically de-risked the whole thing for everyone. That $6.25 billion of existing or remaining margin loan is basically secured against a large chunk of Tesla's collateralized Tesla stock, right? So what it seems, according to our Bloomberg sources, is he wants to boost the equity portion further, take the margin loan component completely out of the equation, and then further de-risk. But we don't know who he's talking to yet. Got some big names on board, but there's still room for others to come in. We do know that Apollo, for example, could come in and support with about $1 billion.
Ed, thank you. As always, get some rust, buddy. We're down 10%
Thank you.
on Twitter, on Tesla, up by 3.8. Michael Nathanson joins us now from MoffettNathanson. He joins us on the phone. He has a neutral rating on shares of Twitter and a 54.20 price target, given that that's the agreed price of the deal. Michael, I've got Mohamed with me too. He might ask you a question along the way, but let's start here. Your thoughts on this morning?
Oh, my gosh. My thoughts this morning is if I was Elon Musk, which I'm not, I would want to do anything I could possibly can do to get out of this deal at this price he set, right? This price makes no sense. We said, remember a couple weeks ago, take the money and run. Sure, there's spammy, bots. This has been a problem for Twitter forever. maybe we use that as a reason why I could get a lower price. Like that's my thinking. This, he has to raise debt as well, and I'm not sure that I can find too many lenders who want to lend against Twitter at the rates that he'd want to borrow against, right? So he may have a problem raising the debt component here at a reasonably good rate because, as you know, Twitter's never really created that much cash flow, right? The business is not a very healthy business, and I don't think you can lever it up. So I want a lower price if I'm Elon Musk.
So, Michael, does he want a lower price because of everything you've just said, or because we've had a massive correction in tech stocks, and before today, Twitter held up pretty well because there was a deal on the table? Which one is it?
It's both, because you had a correction in tech stocks, in our ad-supported names, because there's weakening demand over the second half of this year. So, he made a bid for our stock ahead of earnings. You'd think he would have waited to see kind of how the first quarter and second quarter would have played out, given the weakness in the macro. So I think it's both, Jonathan. I think you've seen a fall in some of these names that we cover because of the macro concern on advertising, and you've seen a derating because of higher interest rates, right? So it made no sense to do a deal based on first quarter results at the price that he did. So it's all the above, as I'd say.
So, Michael, let me take you from price to process. It's not unusual for someone who's doing due diligence to come across something new. It's not unusual for someone to ask for more information. What's unusual is this radical transparency. Share every step with the rest. Look, we've seen the intelligence side declassified information about Russia and Ukraine in a way they've never done before. Are we entering a world, especially in your segment, in which investors will expect a lot more transparency in corporate actions?
That's a great question. I think that this is so Elon Musk-centric. We've seen other deals recently in our group. I can't imagine another person would negotiate so publicly with so much disclosure coming at you. So this to me is a unique situation that I don't think I can read into. I really don't. I think it would be, it's somewhat troubling because if you're an investor, you're getting whipsawed in the pre-market pretty violently here, right? So it's not very healthy.
I'm not a lawyer, neither are you, but you are an analyst who has to cover these names. Is there any regulatory risk around just the way this process has been conducted?
Well, Jonathan, I think you will see SEC. I mean, there's these rumors coming out of Washington that the regulators are quite unhappy with how this process went down. He failed to file a couple of major forms he should have filed ahead of time. So, I think to the integrity of the markets and the individual investor, I think they're going to probably be more, there'll be more discipline to come from D.C. regarding Elon Musk and how he handled, Twitter here. And even to Mohamed's point, I don't know if you have to, if this is a material disclosure that you file before you put out a tweet, right? If there are investors who will now look to sue Elon Musk for disclosure issues, right? I don't know, but you're moving into a territory that we've never seen before, and I don't think people in D.C. will be happy with how this has gone.
Michael, awesome to catch up. Thank you, sir. Michael Nathanson there of MoffettNathanson. The agreed deal is 54.20. The price in early trading just short of 41. We're down about 9%. Big tech's been all over the place, not just Twitter. Let's get to Katie Lyons for more. Hey, Katie.
Hey, John, it's been all over the place, but mostly the direction of travel has been downward. Today is the exception, but that is a rare break for a sector that has really just been on a steady decline all the way back to November. That was when the NASDAQ Composite Index hit its record high about a month and a half before we saw the all-time high on the S&P 500. And since that date, November 19th, this index is down 28%, more than a quarter below that record high. Now, in percentage terms, we have seen bigger drops than that before throughout history, but in dollar terms, $7.6 trillion has been wiped off the market cap of that index. That is more value than was destroyed during the financial crisis, during the pandemic sell-off, or during the dot-com bubble. That is the scope and scale of the destruction we have witnessed. And of course, one of the biggest poster children of that has been the ARK Innovation ETF, Cathie Wood's flagship fund that holds a lot of speculative, expensive stocks. That is down, trading around levels last seen in March of 2020, almost as if the pandemic gain it enjoyed has not happened at all. And yet what's interesting is this is still a fund pulling in cash. This ETF is set for 5 straight weeks of inflows. So maybe it's the faithful remaining faithful, John, or maybe this is starting to be some bottom fishers coming in and betting that the worst is over.
And Kelly, thank you. Mohamed, a question I've been dying to ask you. Was this a bubble bursting? Do you believe this was a bubble bursting?
I do, and I think that it has happened so far in a relatively orderly fashion. I know that these numbers are horrific because there's massive wealth destruction, but let's not forget where we've come from. We had an adjustment coming, and it was going to happen when liquidity starts being an issue.
So as we reset and think about going forward, the appropriate multiple on some of these names and some of these businesses doing some of these things, how much has that changed?
Oh, it's definitely changed from a few months ago, but I still think that they are going to be high, and they should be high. This is the future. Digitalization is the future. And these businesses have a remarkable combination that makes them both having pricing power and having inelastic demand. And when you enter a world of high inflation and low growth, you want your names to have these two attributes.
This speaks to the exposure that we talked about that you've taken in the last 24 hours in this equity market. We're thinking a lot about where the leadership comes from when you get a bounce and this is all over and the low is behind us. That's hard to predict. Let's get away from that stuff on where the low is, but where the leadership will be. Are you saying it's the old playbook then? It's what won in the last cycle will ultimately win further down the road?
So I want to stress, for the short term, this is a short-term technical call. I still think we have one more risk factor to play out, and I'm not going to change what has been a very barbell positioned, ultra safe, and then a few private market positions, and I basically voided the middle. Okay, I'm not going to change that construct until I see that fourth factor play out. And when that fourth factor plays out, then public bonds and public stocks are going to be really attractive.
What's ultra safe?
Ultra safe is short-dated bonds of high quality. You heard earlier about some significant value in short-duration municipals. I think short-duration treasuries are attractive here. Are they protecting you in real terms? No, but they're better than the alternative.
Are you forecasting a mess further down the curve? We've seen 320 this week. We've pulled back Monday, Tuesday, Wednesday, Thursday. As James Athey said earlier on the programme, it's just a 4-day trend. You can't really get your hands around that in a massive way. But are you suggesting that, given your 4-step playbook for how this plays out, and by all means go through it again for people just tuning in, that there's more pain in bonds further down the curve in the Treasury market?
So, John, I don't know a single person who can explain with confidence the movements of the last few weeks in the longer end of the curve. We've seen the type of volatility that should not happen for the deepest benchmark market in the world. Given that, you've got to be cautious. Look, my playbook has been first worry about interest rate risk because of inflation, then worry about tightening financial conditions plus a growth scare. That's what we are going through now, and we have seen the pain of that, and then keep an eye on market functioning. That's the simple playbook, and so far it has helped tremendously.
To hear you say, though, that where we traditionally think there was safety, you're saying there won't be. Can you give me a better idea of, just visualize this, how this is going to play out? You get to that last risk, those dominoes start to fall. The risk is at the long end of the curve. What does that look like? Is that a given day up 20, 30, 40, 50 basis points? What does it actually look like?
Okay, so you've got to understand you have a 9 trillion Federal Reserve balance sheet. That means that the safe haven has been distorted to such an extent that when conventional wisdom changes, there's no risk absorption in the system to accommodate that. So you get these massive gapping. You've said it yourself. 320 one day, 282 the next day. And very little news for that. So you've got to respect that this market has been distorted massively by central banks, and it could start doing really strange things that would contaminate the whole capital structure.
And when you've seen that play out, that's your buy signal?
That will be my buy signal, because I think at that point you will get massive contagion. And the Fed cannot step in the way it has in the past. It has an inflation problem, it has a credibility problem, it just can't flood the system like it did in the past.
Can I tempt you to stick around to talk politics down in Washington, or would you rather skip that?
I'd rather leave that to you and Anne-Marie.
I thought you might. Mohamed, this was nice. It's been too long. Let's do this again soon. Mohamed, thank you so much. Coming up, inflationary pressures putting the pressure on Biden.
I don't think anyone doesn't think inflation is an issue. The president has said that countless times. The question is, what is your plan to address it?
It's a big focus for this president. The conversation up next.
I don't think anyone doesn't think inflation is an issue. The president has said that countless times. The question is, what is your plan to address it? He laid out a multi-part plan yesterday. He has taken a range of steps, including steps that he even announced this week to lower the price of high-speed internet for tens of millions of Americans.
President Biden making inflation his top priority, doubling down on his messaging throughout the country and gearing up for another busy slate of events next week. Bloomberg's Anne-Marie down in D.C. for more. Hey, AMH, how are you?
Hey, Jonathan. Yeah, we heard there from the press secretary really trying to make this inflation debate about their plan versus what they say, opening the cupboard, and there's no plan in for the Republicans. But this is clearly an issue that is dogging this administration. Even today, we have gasoline prices again at a record high. Now, they will talk about the SPR release. Now we have Speaker Pelosi saying that next week in the House, she's going to bring forward a bill. The name of that bill, Jonathan, called Consumer Fuel Price Gouging Prevention Act. Basically saying in these times of national security, the president can make it illegal for companies to price gouge. The issue is, how do you prove that? So they're trying a number of things, but the issue is the problems that they have right now, they're not going to be able to fix overnight. And this is just going to fuel some of these inflationary pressures.
Anne-Marie, the problems are not going away anytime soon. AMH, thank you. Crude has been going through the roof, even though it's settled down. Gas prices have kept going higher. Joining us now is Sarah Hunt of Alpine Woods. Sarah, I want to start with the energy story. Is that something you want to stick with?
I think so. I mean, currently we've got some issues with bottlenecks in refining, and to the extent that even analysts can't judge what refining earnings are going to be, I'm not sure how anyone can judge when you're seeing price gouging. You have to think about the fact that you've got low-cost oil that comes out, and then you've got to replace it with higher-cost oil. But I don't think that the demand situation in hydrocarbons is going to go away as fast as the expectations were when people were thinking, well, we're going to a greener economy, therefore we don't need old school oil and gas. We're going to be able to move to different things. It's not going to be that fast. It's not going to be that quick. And in the interim, we have been not investing enough and also closing refineries. Now, all of a sudden, we realize that that might not have been the best choice. So yes,
Sarah,
stick with energy.
Where do you want to play it? Do you want to play it upstream, downstream, a big integrated player? How do you want to play that story in the equity market?
So I think you want a little bit of a blend there. I mean, first of all, they tend to all move together. So I say that, but at the same time, I think that the energy stocks tend to move as a group. We like some of the integrateds. We've been in Chevron for quite some time. They're also working very hard to try to add green to their portfolio. And I think that it's the people who are in this industry that are going to be able to help this industry get out of being having the reputation that they have. We also like some of the service stocks. You know, there's a local U.S. driller called Helmerich & Payne. We like that too. The stock has moved quite a bit recently, but you know, things like that, things like Devon, we're also involved in. We like that stock as well. It's got a great dividend yield. It's not as high beta as some of the other oil stocks, but I think what you want is a strong balance sheet and a company that's committed to doing the best thing for its shareholders as well as itself.
You've talked about a future where tech becomes like staples. Certain names behave that way. Do you think, though, there is a risk that we consistently underestimate the cyclical story embedded in some of these names? I'm thinking Meta, I'm thinking Alphabet. Where are you on that, Sarah?
I think that there is a cycle, but it's not as deep as it used to be, because we used to look at the cycle in tech as like a hardware cycle, and then those big valleys and those huge peaks. I think there is some cyclicality, and I think to some of the stocks that have advertising, that's going to go along with the economy. But I mean, look at where we are now. And as horrible as it's been, this has been a lot of multiple compression, right? So you came into this year with multiples that were high across the board. And I think that as they come down, it's been exceedingly painful. But it doesn't mean that the companies with good balance sheets, good products, and to Mohamed's point earlier, the kind of ability to continue to raise price and inelastic demand is still something that you're going to want to be involved in.
Sarah Hunt, awesome to get your view on things from Alpine Woods. Sarah, thank you. Just looking at the banks again this morning too, we actually have a day of gains after 6 straight days of losses on the banks on the S&P 500. JP Morgan just about positive 0.8. On the year though, down 24.8%. Goldman down 20. Morgan Stanley down 18%. You're familiar with these moves. Citigroup down 21.6 year to date. Bank of America down 20 full percentage points. Up next on the program, your trading diary from New York City this morning. Good morning. This is Bloomberg. "26 minutes into the session this Friday morning. Good morning to you all. We are positive by about 1.7% on the S&P. On the Nasdaq 100, up by 2.66. That's the price action. Here's your trading diary. The UMich Sentiment Survey coming out at the top of the hour. Looking forward to that. Alex Steele, Guy Johnson will break that down for you. More Fed speak with Neil Kashkari at 11 a.m. Eastern Time. More Fed speak from Mester later in the day. Plus, President Biden speaking again at 3 p.m. Next week, look out for retail sales. That is your big one. Next Tuesday morning, 8:30 Eastern. From New York City, I'll see you later for Bloomberg Real Yield. If you cannot make that, have a fantastic weekend. This was the Countdown to the Open. This is Bloomberg.